Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Hey, it is Thursday. I'm sorry, I took a little bit too long to eat. I was just like really into whatever it was I was thinking about. I don't even remember what I was thinking about. But hey, we're having some movement here off of the news that we just got, the jobless claims. Initial jobless claims, 229,000 versus an expected 220. That can't be what's causing that movement, is it? Well, there was like a huge run up before it. Maybe it's because of the ECB. Okay, we got ECB going here. And are they starting their press conference? They'll start the press conference here in about 10 minutes. So maybe that's why I was a little bit late. I knew it was the ECB conference today. And I'm like, this is not my favorite. Yet the saving grace is that there's some good looking reporters at the ECB. Okay, so volume profile here, Treasury. Okay, so after all of that hubbub yesterday, they ended up, after we were gone, moving up. So like they completely, oh my gosh, this is all so confusing because, okay, there was ADP, and then what was it? Oh yes, it was the services ISM number, or ISM services PMI. Yes, and it was better than expected, and so the market really didn't like that. But then they decided it didn't matter, or were they buying for other reasons? I'm not sure. Oh my gosh, my allergies. Okay, so Treasury's kind of holding this, and now we're getting some movement here this morning again. S&P 500 loved it though, man. Look at that run. Whew. That's a run. Am I going to have a sneezing fit here this morning? Sometimes I'll go into like a complete sneezing fit. Okay, oil recovering a little bit yesterday, actually. So it is still, that chart still looks awful though, doesn't it? Gold and silver also coming back a little bit. Copper, well, okay. Yeah, could be better in copper. But... Okay, Japanese yen still just kind of like bouncing on the bottom there. I don't like that at all. And the dollar similarly bouncing along 104 even. And then we get Bitcoin holding its gains from 2 days ago, just above 70,000. So that way we at. So I might be fiddling. I'm trying a different chair here for. I still love my other chair. It's there in the back. You can see it. I really love that chair. It's so effing comfortable. I really think it is like the most comfortable chair in the world. But it doesn't have support like in my upper mid back. So I'm trying this chair. This is a Steelcase Leap. Like old one. I bought it used for like $100. I'm gonna try that for a week or two. See how my middle back feels, if that improves my middle back. So I might be fiddling around with that a lot today. Moving the seat forward just a little bit. Hit my butt in there. Blow my nose. You should see the monster I've become. I was like taking notes on that yesterday. I was like, is it my armchair? So I went and I wrote this big long thing of notes about all of the stuff and oh my gosh, my different options and everything. And then as I was doing that, I came across something. I was like, oh, well, even if I don't use that chair, I want those because my kids could use them. Those are great chairs. So I ran down there and got it. Just the arms a little bit. Oh yeah, that's
Block by.
good. The adjustments are much more granular on this. Okay, so we had that big up and we came back and now we're just chilling at 110.06 half. We have an ECB press conference here. Let's pull that up. Where's my ECB? Here we are. I hate that they have their own background music. Okay. So we'll put them over here. How does that look? And then let's come and deal with the notes. So ECB press conference, initial jobless claims, slightly higher than expected. We do have a bill auction. What else we got going on? I feel like I'm missing something. Maybe I just feel like that because so much happened yesterday. Oh yeah. Well, we should note that tomorrow, non-farms tomorrow, because that could constrain activity here. So I'm expecting that we will get a somewhat active but constraints. So what happens in these sorts of situations is you get kind of a lot of spurious volume, but not necessarily good trends. If you do get, but what you will get instead of a trend is just like a jump. You know, they said something in the ECB or whatever. I don't like trading during these things. So I love to talk during them. But we will try to pay attention as best as I can. No, I won't. I'm going to type. That's what I'm going to do. That's why I feel like typing. You know what it is I'm supposed to be peaking for my weightlifting on Saturday. And so my nervous system is like, so like the few days before you have a hard time sleeping, like your nervous system doesn't want to go to sleep. I was definitely feeling that last night. Okay. Okay, so I was typing pretty fast at points in there, but I had some real accuracy problems. thoughts on the SX guys that made millions during when oil went negative? Also, what were you doing in this time in relation to trading? I think it was during COVID. So I think I've heard of the guys that you're talking about. I don't know. There was a lot of weird things that happened back then, right? I remember when oil was going negative and I kind of stayed away from it. But the press conference is starting here. The thing that I remember was that when the volatility got really high during like the depths of the COVID thing, I pretty much like went on hiatus. I was just like, put the account in hibernation and just didn't touch it. There were points at which I probably could have done okay, but whatever. And then during like the recovery summer, I was trading at Sim, and I was working with some ideas around multiple time frames, which have some use. Okay, that they're not terrible. It's just kind of like they're very high time frame, so you need a lot more than that. But I was kind of basing my entire trading off of these signals of like when it goes positive and stuff, and I did really, really well during that summer time period on Sim. But like everybody was doing well, like the market was just doing really well, right? Then later when it like came to August, September, I was not performing as well, and that was when I was really able to, anytime that you have trouble, it's kind of a good thing, I think, because it forces you to dig a little bit deeper. So I dug a little bit deeper, and that's where we found, or when we found, a lot of the content that is the cornerstone of our channel today. So I didn't these were all things that I understood before, but not in the way that I came to understand them after COVID. Because before it was like somebody had told me, a trader at a bank had told me these things, and I trusted them, and I understood the market pretty well. But after that, I understood the math behind it. I understood the research where it came from, and I could, because I understood the research, that allowed me to be able to apply it more specifically to my trading and create, like a system to be able to use it, and a system to be able to teach it to you guys. And that's where like the big changes came from. So I went through a bit of a renaissance during COVID, I think. All right, we should turn up the ECB here.
More than 2.5 percentage points, and the inflation outlook has improved markedly. Underlying inflation has also eased, reinforcing the signs
in this meeting, they're going to be looking for signs of like where do they go next?
Monetary policy.
How many more rate cuts will there be, etc., etc.
By dampening demand and keeping inflation expectations well anchored, this has made a major contribution to bringing inflation back down. At the same time, despite the progress over recent quarters, domestic price pressures remain strong as wage growth is elevated and inflation is likely to stay above target well into next year. The latest Eurosystem staff projections for both headline and core inflation has been revised up for 2024 and 2025 compared with the March projections. Staff now see headline inflation averaging 2.5% in 24, 2.2% in 25, and 1.9% in 26. For inflation excluding energy and food, staff project an average of 2.8% in 24, 2.2% in 25, and 2% in 26. Economic growth is expected to pick up to 0.9% in 2024, 1.4% in 2025 and 1.6% in 2026. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decision will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of
The thing I
monetary
appreciate
policy
about the
transmission.
ECB is when they say they're going to do something, they
We
do
are
it.
not pre-committing.
I feel like all of
to
the
a rate
central
path.
banks understand the importance
The Governing
of
Council today also
you know,
confirmed
the
that it will
market
reduce
having
the
advance
Eurosystem's
notice.
holdings of securities under the Pandemic Emergency
Obviously,
Purchase Programme
they can be
by
wrong.
7.5 billion per month. On
I think what's
average
going on
in the
right
second
now
half of the
is
year.
in the United
Modalities for
States,
reducing the
we're
PEP
importing a lot of
holdings
labor
will be
over the
broadly in
border.
line with
And
those followed
on top
under
of
the
that, I
Asset
think that
Purchase Programme.
some of the data measures
The
that we
decisions
rely
taken
upon
today
have
are
some
set out in a press
weaknesses
release
that are
available
kind
on
of
our website, and I will now
really
outline
getting
in more detail how we see
hammered
the economy
right
and
now.
inflation developing.
like we've come into this situation
And we'll
where
then
those
explain
weaknesses
our
kind of come
assessment of
out, and
financial and
we're only
monetary
people are kind of
conditions.
realizing it late. So the Federal Reserve
at the economic
probably should be
activity.
cutting interest rates right now too,
After 5 quarters
but they're
of
not because
stagnation,
their data
the euro area
does not
economy
support it.
grew
ECB's
by
Lagarde says
0.3%
manufacturing
over
shows
the
signs of
first quarter of
stabilization.
24.
I expect the economy to continue to
The
recover.
services sector is
I'm
expanding.
late. You haven't missed
recovery to be
anything.
supported by
ECB
rising
cut rates
real
as
income.
expected, and we're listening to the press conference.
At low levels. We expect the economy to continue to recover
ECB's Lagarde says
as
stronger
higher
exports are to
wages
support growth in
and
the coming
improved
quarters.
terms of trade push up real incomes. Stronger exports should also
And
support
Lagarde adds that
growth
policy
over the
should be
coming
less of a
quarters
drag on demand
as
over
global
time.
demand for goods and services rises. Finally, monetary policy should exert less of a drag on demand over time.
And Lagarde says surveys point to
Employment
continued
rose
job
by
growth in the near term.
0.3% in the first quarter of this year, with around
Oh yes, mute the
500,000
squawk.
new
Totally
jobs
right.
created,
Sorry.
and surveys point to continued job.
We don't need him to repeat everything that she just said. Yeah.
The annual
Totally.
unemployment rate edged down to 6.4% in April, its lowest level since the start of the euro. Companies are still posting many job vacancies, though slightly fewer than before. National fiscal and structural policies should aim at making the economy more productive and competitive, which would help to raise potential growth and reduce price pressures in the medium term. An effective, speedy, and full implementation of the Next Generation EU programme, progress towards capital market union, and the completion of banking union, and a strengthening of the single market would help foster innovation and increase investment in the green and digital transitions. Implementing the EU's revised economic governance framework fully and without delay will help governments bring down budget deficits and debt ratios on a sustained basis. Looking at inflation now. Annual inflation rose to 2.6% in May from 2.4% in April, according to Eurostat's flash estimate. Food price inflation declined to 2.6%. Energy price inflation increased to 0.03% after recording negative
Especially
annual
yapping,
rates
I want
for a year.
another try at typing here.
Goods price inflation continued to decrease in May to 0.8%. By contrast, services price inflation rose markedly to 4.1% from 3.7% in April. Most measures of underlying inflation declined further in April, the last month for which data are available, confirming the picture of gradually diminishing price pressures. However, domestic inflation remains high. Wages are still rising at an elevated pace, making up for the past inflation surge. Owing to the staggered nature of the wage adjustment process and the important role of one-off payments, labour costs will likely fluctuate over the near term, as seen in the pickup in negotiated wages in the first quarter. At the same time, forward-looking indicators
I should be able to get that to
signal
100.
that wage growth will moderate over the course of the year. Profits are
Accuracy not
absorbing
quite there.
part of the pronounced rise in unit labour costs, which reduces its inflationary.
This is a problem, is that like when my nervous system is really primed, it's like, okay, I'm good to go, I can act, but
including due to energy-related base
I
effects.
don't necessarily,
And it is then
I'm not
expected to
accurate, you know, I'm
decline
not
towards our target over the second half of
always
next
the
year,
best decisions.
owing to weaker growth in labour costs, the unfolding effects
Maybe
of our
that's just
restrictive monetary
my
policy,
brain
and the
chemistry,
fading
and there's
impact
nothing I can
of
do
the
about it,
energy
but I kind of
crisis
feel like
and the
that
pandemic.
we can work on that.
Measures of longer-term inflation expectations have remained broadly stable, with most standing at around 2%. Turning now to our risk assessment. The risks to economic growth are balanced in the near term, but remain tilted to the downside over the medium term. A weaker world economy or an escalation in trade tensions between major economies would weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could also be lower if the effects of monetary policy turn out stronger than expected. Growth could be higher if inflation comes down more quickly than expected and rising confidence and real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected.
So that's funny. The ones like that last one,
Could turn out
where I
higher
got
than
like
anticipated
216,
if wages or profits
I felt
increase
though it
by
felt
more
slow.
than expected.
So
Upside
like over
risks
200
to
milliseconds
inflation
feels slow to me right now. That's
also
a little weird.
stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term.
That
and
still
disrupt
only puts
global
me
trade.
slightly above it. How are these people doing like
Moreover, extreme
below
weather
200?
events and the unfolding climate crisis more broadly
20
drive
milliseconds?
up
Oh,
food
it's only
prices.
like 6 because it's a 144
By
hertz
contrast,
monitor.
inflation may surprise on the downside.
Maybe if I had a 240 hertz monitor to help a little
dampens
bit, but
demand
no, it's
more
mostly
than
my reaction
expected.
time.
Or if the economic environment in the rest of the world worsens unexpectedly.
I don't know. That's
So,
kind of like
our
me at my
financial and
best right
monetary
now is
conditions review.
me average 10
Market
years ago.
interest rates have risen since our April meeting. Financing costs have plateaued at restricted levels as our past policy rate increases have worked their way through the financial system. The average interest rates on new loans to firms and on new mortgages were unchanged in April at 5.2% and 3.8% respectively. Credit dynamics remain weak. Bank lending to firms grew at an annual rate of 0.3% in April, down slightly from the previous month. Loans to households continued to grow at 0.2% on an annual basis. The annual growth in broad money, as measured by M3, rose to 1.3% in April from 0.9% in March. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks remain resilient,
That time I didn't even feel
Moving
like I was
economic
actually
outlook
typing that
has
fast.
fostered
And it
financial
just was
stability,
like faster.
But heightened geopolitical risks.
Maybe I
cloud
just needed time
the
for the
horizon. An
medication and
unexpected
stuff.
tightening of global financing conditions could prompt a repricing of financial and non-financial assets with negative effects on the wider economy. Macroprudential policy remains the first line of defense against the build-up of financial vulnerabilities. The measures that are currently in place or will soon take effect.
Yeah, it's
are
also
helping to keep the
interesting
financial system
that
resilient.
I was very consistent that time too.
In conclusion, the Governing Council
give it one more
today
time and
decided
try go
to
real
lower
fast?
The 3 key ECB interest rates by 25 basis points. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve that aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth
That
functioning
wasn't better.
of monetary policy transmission.
Trying really hard didn't
We are
make it
now
better.
ready to take your questions.
Thank you, Madame Lagarde. And the first question goes to Annette Weisbach of Siemens.
All these
Annette, please.
guys could just end their speeches with just that one line,
Thank you very
restrictive
much for
as
taking my
necessary.
question. My first one would be like a general one, because clearly cutting rates at the same time with hiking the inflation forecast needs perhaps a little bit more
Yeah,
explanation.
I feel like that they
and
always
also the
say the
question
same
whether
thing
perhaps
over and over
pre-committed
again.
yourself too
But the
early
way
to
that the media
cut.
works,
The
man,
second
it's
one is,
like not.
the market currently is expecting some 65 basis points in cut during the course of this year. Is the market right?
So like
or about
think
right?
of it from the perspective of the policymakers,
Well,
right?
thank you so much for
I'm
the opening
talking to the
question,
media.
and let me
I
take this
would
opportunity
like
to give you
the
a bit of an
public
opening answer
to understand a
and,
certain
tell
thing,
you
right?
what
Or maybe I want the markets
what
to react a
we-
certain way.
what we did this
Maybe I
morning and
think
what
that
happened,
the markets
as a
are too
preamble
loose, and
to
I
this
want the
morning's
monetary
decision.
policy to be
But
more
let me first
restrictive,
tell you
right?
that we started our meeting this morning.
I might be able to come out
by
and just say
paying
one
tribute,
thing the right way, and everybody
to the
gets
many
it, and
men
then the
and
market
women who
reacts, right?
sacrificed their
But what if they
lives
don't react
on
to
the
that
beach
one
of
thing, right?
Normandy
Then
today,
I'm just
which
going to
is
keep
the
talking, and I'm
80th
going to say it in a
anniversary
slightly
of
different
D-Day.
way, and
And we
until
pay tribute to
the
those
market
sacrifices
figures it
and
out
those
and
of many
reacts the
others,
way that I want,
because
right?
it enabled us
And
to
I think
build
that
what
that's
we
a
have
lot
built,
of what goes on.
to disagree in a very civilized way.
Is that they're saying the same thing
very
over and over again
harmonious
until
and
the market
congenial
algorithms or the
decisions
media people,
amongst
you know,
20 different
finally pick
nationals
up
representing their
what
respective national
they're trying to have
lines
happen.
amongst our governing council. And it was perfectly appropriate and fitting to do so. Then we decided to cut. And we did so because overall, our confidence in the path ahead, because we have to be forward-looking, has been increasing over the last months. So let me explain to you.
So far, the
Why
market,
our
there
confidence
have been
has
points where it
increased in
seemed
the
like the
path
market moved a few ticks, but we're still like
But
right
I will
at
take you
06.
back a little bit, because this is, after all, the first time in many years that we make that kind of decision. And these things do not happen in a vacuum.
New
So I'll
York
take you
Post
back a
says
little bit
Travis Kelce
to
feels
our
on top
monetary
of the
policy
mountain
cycle.
after
To remind
epic
you that
offseason as
we
Taylor
have had
Swift romance
2
intensifies.
phases.
Cat Turd
And
retweeting this
we have
with a
made
bunch
that
of
decision.
smiley face, with a bunch of
So the
laughing,
first phase, as
crying
you will remember,
faces.
was a phase
Okay.
of very robust and rapid tightening. We tightened by 450 basis points between July 22 and September 23.
I saw somebody go into politics,
we moved into a
doing and
phase
saying, "Why
of
don't politicians
holding
answer their questions?"
September
And he came out
23
saying, "Why do
up
those
until
idiots
today.
ask such stupid questions?"
And if I look back, and we look back at those phases,
Robust. She likes that word. Done.
during each of those phases, we divided inflation by half. So if you look at the peak of inflation, October 22, we were at 10.
I really think that
double-digit inflation on
that
average.
Lagarde is underrated.
Now fast forward,
Underrated in terms of
September
meme potential.
23,
right?
we are at 5.2.
There's be so many great memes
Fast
that could be
forward to
made
today,
about her, and Wall Street
we
bets
are
don't
at
care because
2.6.
she's in Europe.
So at each and every step of the way, when we
But she's
reassessed
fun,
and
I think.
decided to move in a different
I mean, I don't really know, but just based on
inflation.
watching her in these press
I think the
conferences
second
and everything,
element that we took
I
very
think she
much
would be
into
fun to
account
work with
was
or to work
the
for.
reliability and the strength
She seems fun
of
to
our
work.
projections. And there is one particular line of projections which to many of us was relevant. If you look at Q4 25 projections,
I don't know.
You
It's,
look
it's
at
just so
September,
weird
you
to
look at
watch
December,
her
you look at March,
compared
you
to
look at June.
Jerome Powell, right?
there's a variation between
Jerome
those
Powell is
projections.
not a
0.1.
gifted
So
communicator.
it's either 2 or 1.9.
I'm not going to say he's not a gifted communicator, but he's not a gifted communicator
And it's on the basis of this
by nature.
reliability and solidity.
He's gotten
and,
pretty good at it, I
yeah,
think.
robustness
But
of those projections.
that is,
that
I don't
we
think
have
that he
made
ever in a million years thought that
decision
he was going to be
to
president of the Federal Reserve.
But we
like,
have done that.
This
and I
public
will-
speaking
I'm sure
thing
that
was
you will
not
be
something that
asking,
he
what
ever thought he
about
was going to have
next
to do.
time?
He's a wonk
I
that
will
just wanted to
invariably tell
sit
you the same thing, which
with
is what is included
spreadsheets all
in the
day.
monetary
I
policy
think
statement. We shall be
that's what he
data-dependent,
seems like to me.
and we shall decide meeting by meeting.
So you can kind of see the difference between
But
them.
to say
Jerome
that is
Powell
probably not
understands what's going on in the data
And
so well,
we
but has difficulty
Collect data matters,
communicating
but what
it.
is also more
And meanwhile,
important,
Lagarde,
how we analyze
she
the
doesn't
data.
understand that
And I'm
stuff
not only specifically
nearly as
looking at
deep.
one set of
And
data,
yet,
all the
she
data
can
that-
give such a good
We're looking at it
explanation
under the
for
prism
the stuff
of
that she
our
does
three
know.
criteria.
You know?
And you will have noticed that I have repeated
She's
3
a good
times, I think,
communicator.
in this monetary policy statement, the 3 criterias, which are the inflation outlook on the basis of the financial and economic data that we collect. It's the underlying inflation, and it's the transmission of monetary policy. So it's under the prism of these 3 criteria that we analyze all the data that we have available. And we need to have
But on the subject of,
those data
you know,
to make a
like,
relevant and appropriate
they
analysis.
probably hate the questions that they're given and stuff.
Took us this time around to this decision.
You know, it's one of those things that it always comes back to systems for me,
What
right?
was your second question?
And I think the thing that people don't realize
Well, you know,
is they can look at a system
do what
and they
markets
can
have to
say,
do, and we
this
do
system
what
has
we
this
have to
problem.
do.
So we need to get rid of it. We need to change it or whatever the deal is, right? And what they don't understand is you're going to make a new system.
Of Reuters.
And as that new system becomes more mature, it's going to develop its own set of problems.
So where are you?
And we aren't very good at predicting what those problems are actually going to be.
Because you just mentioned that you need
And change for
enough
change's
data
sake is not
to
necessary.
take your decision.
Sometimes
And back in March, you
I
said
think that there's real value
you will know a little
in
more
being
by
able
now
to
and a
look
lot
at
more by
something in
June.
your life or society or whatever
Situation where
and
a
see
little more will be known by
the
next meeting and a lot more by the one
weaknesses in it
after that. And more
and
broadly
be
on
able to
this
accept them.
topic, some
Well,
argue
that's just
that
the way that it works. Something. 'Cause, yeah, you could get rid of them,
meetings
but
coincide
then
with
maybe
these
you
of,
introduce a worse
key
problem.
Indicators.
Then you have to wonder, is it really that
And
bad?
therefore, that those policy meetings are more important.
At what level is it bad enough that you need to do something? I'm not sure.
Thank you.
Is it bad enough where we need to do something when it comes
thank
to
you
the
very much.
media
You are correct
and
that
our
there is
society
not
and so
perfect
forth?
Synchronicity between our meetings and our decisions.
I think
and
that the discourse
publication
online
of particular
and
data.
the way that
Thinking of
social
one
media
particular
is going,
data that will
it's
come
bad
out
enough
of
that we
publication
really need to
tomorrow,
make a
which
major
is
change.
the compensation per employee for Q1, which obviously is relevant.
But with a
because we
lot
look very
of
carefully at wages,
economic things,
from
you know,
all possible
weaknesses in our current
angles of
economic
analysis.
system,
And CPE is
I think it's pretty damn good.
Point. It's not the
Obviously,
only one.
there's little things that we can fix
Wages
here and there,
is
but
an
I
important,
wouldn't want to come in and like try and upend the whole
field
system,
of
right?
data that we need to analyze, but CPE is one of them, and it's only being published tomorrow. So what we try to do, that's just to take you a little bit behind the scene, is we collect as many data as is available, and at the moment we have about 15 countries or so, and a very large portion of the euro area economy, and we calculate what is the likelihood of that number to better assess and test our resolve, and that's what we have to do, and there is no perfect synchronicity.
It creates the trend so well, Hannah.
Between the date of publication, which
the trading during these press conferences is never very good for me. So
they're not, coinciding necessarily all the time. You also asked me the question of, what kind of data are we talking about? First of all, it is data. Second, it is enough data so that the analysis that we conduct under the 3 criteria that I have mentioned can actually be relevant. So I'm not going to tell you today, nor at any point in time, until much later on in the summer, whether we do this now or we do this.
the sort of thing that only she would say, "Oh, I'm not going to tell you now."
That we need sufficient data, and data comes in gradually over the course of time. Sufficient data to actually corroborate the view that we have that the disinflationary path is being confirmed and warrants further decisions.
Thank you, Madame Lagarde. And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thanks for taking my questions. You mentioned the different phases the ECB went through with the holding phase recently. And with the cut today, are we entering the dialing back phase you mentioned in your March speech at the ECB Watchers Conference? So should we expect a series of rate cuts, or could it also be a case that this one is a one and done? And the second one, your chief economist recently said that that interest rates need to remain restrictive this year, but that the ECB wants to remove the top level of restriction. What does that mean? How much can the ECB cut interest rates before they are no longer sufficiently restrictive? Thanks.
Well, first of all, thank you for reading my speech, or for having been in the room. That was the Watcher's speech, in which,
oh my gosh,
sort of perspective, but also, I wouldn't elevate myself to that level, but in a vaguely academic way, I tentatively analyzed the phases that we had gone through and anticipated what could come next. Are we today moving into a dialing back phase? I wouldn't volunteer that, because as I said, we are making a decision on the basis of the confidence that we have that we are on a path. But we will need, at each and every point in time, in the course of the next few months, we will need data and more data and analysis of
someday. I'm like collecting it. I'm collecting stuff. So someday when she's no longer president, I'll make a video here on this channel with her greatest hits.
We know the direction that we are taking.
I think she's so much fun, guys. Oh man.
We know the volume of multiple data that we should be receiving and that will accumulate and corroborate, hopefully. But I cannot confirm that it is the dialing process that is underway. There's a strong likelihood, but it will be data dependent. And what is very uncertain is the speed at which we travel and the time that it will take.
Push my chair up a little bit because I don't feel like my weight is evenly distributed. It's like all on my butt. This is probably too high, but
we are currently restrictive, even after this 25 basis point cuts, as you well know. And we were today more restrictive in real interest rate terms than we were back in September. So what we're doing here, as indicated by our chief economist Philip Lane, is removing
something I hate about shares is that it's often like millimeters that you want to change.
How long will that take?
And it's difficult to get it
I cannot tell you now. At
do
what
the
speed
small amount
will
of change that you want.
Happen? I cannot tell you now either. It will be delivered by the data.
Like the thing that I dislike about that chair over there the leaning back is great.
It will take such time.
The first level back is too far back.
I would caution against any such conclusion for one simple reason. We know the path we are on, but we also know
Accidentally
that
hit the
there
thing
will
that made
be
it so it can lean all the way
other
back.
bumps on the road. I said last time when we were together that we were traveling that journey on a road that was downward towards the 2%, but that there would be
Here's
bumps on the
two
road.
notches back, but that's too far
There are
away.
bumps that we can more or
And I
less
can't get the
predict,
chair closer
that we can
because of the
anticipate. I mean, base effects are, case in
armrests.
point. But there are bumps on the road that can come as a surprise. There are bumps on the road that we can anticipate, but the magnitude of which we are not totally confident about. Wages is another case in point. Depending on which country you look at, depending on what collective agreement you look at, there can be a massive amount of catching up. Front-loaded agreement to increase wages, and then it fades away.
Block
So
by.
all these things have idiosyncratic characteristics that will actually either increase, reduce,
They like what she was saying there.
deliver the
This
same
is a
level
big
of
order they
bumps
came
that
through there.
we are considering. But we know it's
I
going
don't
to be
know.
a bumpy road.
Like the treasuries have kind of been on the
The
buy
next few
ever
months will
since they
continue
said
to
the
be,
Japanese
to
yen,
be
Japanese will be
know
buying
that.
bonds, and I kind of wonder how much of the buying
Next
is just
question
because
goes
of that.
to
And I,
Martin Arnold of the Financial Times. Martin, please.
Thank you very much. President Lagarde, two questions, if I may. Firstly, you talked about the importance of the data, and you had stressed before this meeting.
the person left a comment on one of my videos. I've never heard of an SMC trader ever mention the silver bullet. This should be an ICT video.
You didn't say
But ICT invented the term smart money concepts, dude.
Back to almost a record high. So
people
can
are
you
so
explain why what you saw was still enough to allow you to cut? And secondly, you've predicted that there will be a moderation in wages in the Eurozone later this year. Do you need to see that moderation actually happen before you can cut again? Thank you.
Thank you very much for your two questions. So, again, what we wanted before making that decision was collectively to increase our confidence level that the path ahead was on its disinflationary rhythm that we needed in order to make our decision. And to do that, we looked back at the last time we decided to hold, which was in September, and we assessed the journey from September 23 up until now. And as I just said in the previous answer, there are bumps on this road that we are traveling with more confidence. That
a little better. I'm slowly zeroing in on the right setting for me in this chart.
We will be looking at multiple data, not only wages. But you're quite right to take me back to wages, because wages...
I felt that the treasuries were quite volatile today after unemployment. Is that because of the ECB press conference?
To services,
I suspect so, because I thought the exact same thing, Marcus. I was like, this seems to be moving too much relative to what just happened with initial jobless claims, right? So
the last service number that we had was 3.7.
Maybe it was because the ECB is going on at the same time.
4.1 in May, after a series of 4.
That said, it was like a huge spike that came right back,
March,
right?
February, January before that. And what's at the root of this increase in service prices is predominantly wages. So what happened to wages in the last few months? First of all, there has been divergence between countries. So we really looked under the bonnet of wages, and we looked under the bonnet of countries.
You know what? I just
because
realized.
some of the decisions that were made were country specific. I'll take one example, Germany. Germany, because in Germany, most of those collective agreements are negotiated on a triannual, every 3 years. And to give you a more specific example, public service agreement actually happened in 24, and has now compensated
I introduced
the lost
something, a
purchasing
bug into
power
this, dude.
since
I
21,
introduced
which is
a
when
bug
the
into
last
this.
agreement was
What did I
reached
do?
in the public service. So you can imagine that an agreement that is cut in 24 that covers 21, 22, 23 is obviously going to be very sizable.
Wild bug.
And it was
Oh, man.
in the 12%. We have exactly the same story for the retail sector, which is quite significant, where again an agreement has been reached now, which is an ovation compared with 3 years ago. So then we have to analyze what's underneath. There is the catching up, front-loading.
D1CA.
Is it also accounting for future years?
Oh,
It's
right
not
here.
too clear in the public service, but it's very clear in the retail sector agreement. So that leads us to assume that wages will continue to remain elevated. If you look at negotiated wages, Q1 they were at 4.7. If you look at compensation per employee based on what we can calculate on the basis of 15 countries, 4.7%. Compared with 4.5 for negotiated wage in Q4, 4.7, same stabilization on the compensation per employee in Q4. So we have elevated levels, tentative stabilization,
Okay.
and then we look at our third indicator, which is the wage tracker, which includes 7 of the euro area countries, including the largest one. So we cover a very large chunk of the European economic activity and labor markets. And what that wage tracker tells us is that while still elevated for the stock of agreement and various accords that are recorded by the wage tracker, this is still elevated, that's the stock. When we look at the flow, what is coming in now, we are seeing a decline in the wage growth. So it's not an easy matter, wages, because it is peculiar. It includes also lots and lots of elements. You have the catching up, you have what we call the wage drift, which includes a lot of very specific items, including social security contributions, including overtime, including differential between low and high paid employees and all the rest of it. So we try to really combine and confront all this data, all this information, to analyze it, and that leads us to the conclusion that while still elevated, no question about that, we are seeing those wages on a declining path, and that will particularly be the case in 25, because 12% decided in 24 are not going to be producing the same impact in 25. And that is, I think, even, comforted by the fact that this particular projection exercise is checked and cross-checked and produced jointly by the staff of the ECB and the staff of the national central banks, which have really their fingers on the pulse of those collective agreement and compensation per employees. The second part of your question was, how long will it take, or how much more do you see? We are going to look at data as they come in. On wages and profits, it's not a monthly exercise. It comes at a different interval, and we will have to, test our assumption of declining wages towards the end of 24 and seriously less elevated wages in 25 in the course of the next few weeks and months.
Thank you, President. And the next question goes to Silvia Berzoni of the Italian news channel Class CNBC.
I didn't see anything about raising inflation expectations, but they're concerned that that could still happen. So even though they're cutting, they don't want it to run away from them.
Do you think that projection route meeting
It looks like it worked correctly from this perspective. Here's where I created it. You get nothing until
the second question is how divided
we opened things back up again
over the future part of interest
But when I turn it on to
a
tick
third one would be if
replay,
it was a unanimous decision today, but thank you very much.
there's
You can't do
these
more than 2, but okay,
data
I'll take
points
the, I'll
that
take the
end
3.
up being like way wild.
So I'll start with the third one. Was it a unanimous decision? Yes, but for one governor. Okay, so I leave it to
Was
the sarcastic
wait,
audience.
what?
Were we divided as far as the path?
Yeah, yours doesn't do that on.
We were all
Take Replay,
absolutely united to agree that our path would be data dependent, that we would decide meeting by meeting, and there was absolutely no dissent on that front. We also confirmed that our criteria, the three that I have mentioned, inflation outlook, underlying inflation, strength of monetary policy transmission, would continue to drive our analysis of data going forward. Can't remember what your first question was.
This girl.
You'll have to remind me.
Oh, man.
It was about, given that you need data and more data, do you think that projection round meetings of the Governing Council could be more suitable for interest rate decision, given that you will have also forecasts available?
Okay.
Well, first of all, those are not our projection. Those are the projections of staff. And it's obvious that projections produced by staff on a regular basis are very informative, go deep into the data that we receive, analyze at length, produces scenarios analysis, sensitivity analysis, and that this is very helpful for us to make decisions. But that doesn't mean to say, and I would not say that now, that we would only decide at the time of projection meetings, because we have to be data dependent at all times. But obviously we have more data when we have projection meetings.
Thank you, Madame Lagarde. And the next question goes to Klaus Jakisch of...
So because this is not on real-time data where this happened, I can't like just go into the spreadsheet and be
Good
like,
afternoon,
what happened
Mr.
here?
President. Thank you for taking my questions.
But somewhere around here, the numbers got screwed up.
The Governing Council is determined to break the neck of inflation. Would you say that the neck is being broken? One could have some doubts seeing the current data and also your projections. So how is the view on that? And the second connected...
It must be because at this point I set the running thing back to 0.
And a lot of doubts whether
but then it's still
at the right point, because some people are doubting that inflation indeed.
So it does the correct thing where it, here at this point it resets them, but it doesn't say, okay, so now you don't need to minus these ones from before.
When
so
some
then it's
people may
ever
now
screwed
get
up
the
after that.
impression that the ECB doesn't take the combat of inflation seriously enough anymore.
So dealing with session break
well,
on this indicator,
thank you for your question, and I can
more
assure you that we take the fight against inflation extremely seriously. And if there is one thing that I have learned in this job is that we have to be persistent.
But I think I know how to do this.
We have to be data dependent.
Oh, this is gonna be so interesting.
And our objective is to tame inflation and to bring prices back, to bring inflation back to 2% in the medium term. So let there be no doubt about our determination to tame inflation and to restore price stability. And I will mention 3 numbers for you, because I think that, you know, in my sleepless nights, I try to have that in the back of my mind. And there's that little voice that says, carry on, carry on. October 22, inflation on average in the euro
Basically,
area,
what I need to do is I need to make a number,
September 23, less than a year later.
An integer that will store which bar is the session start, and do all of my comparisons against that instead of the other.
Today, 2.6%. Each and every step of the way, we divided inflation by 2. I don't want to divide the next inflation by 2, because if we divide 2.6 by 2, we have 1.3. Our commitment is 2%. We don't want to go there, no. But as is very clearly stated in the monetary policy statement, we are moderating our restrictive stance. It is still restrictive. And we will continue to be restrictive as long as necessary to bring inflation to 2% in a timely manner. Have no doubt about that. Thank you.
Thank you. And the next question goes to Nuria Salobray Fuenteville of El País over there.
Hello, thank you. what do you think about the level of concentration in Spanish banks, and what could happen with this if BBVA is successful in his offer for Sabadell? It could be a problem for competence or maybe for the financial stability. Thank you.
Thank you so much. Somebody far more competent than me on that one. Vice President.
Well, good afternoon. Well, I think that we have been crystal clear with respect to the, this kind of situations. We do not elaborate, we do not comment on transactions, deals that have not been finalized yet. Our party line has been quite clear. We will make an assessment about any kind of transaction that implies mergers, the purchase of stakes of banks. But, this assessment will be based on prudential and solvency issues. That's what I can say now. And, well, we will see, the outcome at the end.
Thank you, Vice President. And the next question goes to Santi Pignol of MNI. Santi, please. Here.
Good afternoon, President Lagarde.
Good afternoon.
So, my question is, in the moment that we are right now, can you be now more clear in the assumption where the neutral rate is, they are still currently? And the second question, the governor that was on board on the cut was looking for a bigger cut or an unchanged rate cut, like keeping on hold? And what was the argument, if you can tell us something about it?
The answer to that question is no, because that's the privacy of the deliberation to the extent that they relate to one particular person. But I'm sure you will identify that person quickly and will be able to get that information from him. Now, more seriously, on the neutral rate, you know that I have refrained systematically from erring towards a particular number or identifying a neutral rate or a range around the neutral rate. I will simply say this, is that if it has increased compared to where it was before COVID, we also know that we are far away from neutral rate now. And by moving from 4% to 3.75% on the DFR, we are not close to the neutral rate. So we still have a way to go.
Thank you very much. And the next question goes to the lady in the pink.
Hold on a second.
In the pink jacket, please.
I won a lottery, so thank you. I'm Silvana Skočajić. I'm coming from
I
Croatia.
made a mistake and updated the old version of the indicator for a certain
zone. So I was wondering, since we are still having the highest rate of inflation in May, 4.3, behind the Belgian, second. But on the other side, we have the biggest growth in Eurozone. In last quarter, it's 3.9. So are we in risk because of this decision of today? And what do you expect? How it's hard to really make a decision that affects all these countries in Eurozone, and you expect, to inflation to really go down? Thank you.
Well, first of all, welcome to this circle, and we're very happy that Croatia has joined and has extended the circle to 20. Your question was similar to the ones that we had when some of the Baltic states, in particular, were cruising at a much higher interest rates than the average in the euro area, and it's the whole issue of divergences that we have amongst ourselves, because we have different fundamentals, because we have different heritage, because of different structural rigidities as well. And we have, from an ECB standpoint, we have to look at euro area data, and we cannot go down into the specificities. We have to be mindful of the divergence, and we do publish We will be publishing soon, actually, a convergence report that will identify these divergences and how close countries are getting. We very much believe that inflation will come down. We will continue this disinflationary process, and that will apply to all member states. But again, the pace, consistency between countries is always going to be an issue. I hope it's not too big an issue, and obviously to have growth and strong demand has its disadvantages as well as benefits. Thank you.
Thank you. And the last question today goes to Jan Malin of Plato, here in the front row.
Hello, Madame Lagarde. Thank you for the opportunity. The French President Emmanuel Macron has proposed to extend the mandate of the ECB to economic growth and climate protection. What's your view on that? And I would be curious on your view also on the proposal to publish dot plot from Isabel Schnabel. Would you support this idea or not? Thank you.
I think that I made a couple of changes yesterday and thought that I had saved and built them, and I had not.
At the European Central Bank, we have a very clear mandate, and that mandate is enshrined in the treaty, and that mandate is a focus on delivering price stability.
Yeah, that's better.
We believe that that price stability mandate provides solid guideposts and boundaries for our monetary policy strategy. We don't see a need, nor do we have the capacity or the competence to change that. I would also observe that providing price stability and giving predictability to sustainable investment is certainly one of the various contributions that we can make in relation to the fight against climate change. We have different set of
what I'm going to do here now.
From risk management to better
I'm going to restart
modeling and including climate change risks and mitigation measures in our work. But providing price stability is certainly a good way to tell those investors in sustainable projects, you have price stability, and the ECB will be here to guarantee that prices are stable. There's nothing like, waves of inflation to discourage investment that require a long-term perspective and a later return on investment. The dot plot mechanism is an interesting concept, and I think I would leave it at that.
That brings our press conference to an end. Thank you very much for following. Our next press conference is on 18th of July, and up until then, all the best. Thank you.
Have a good summer.
7:38 isn't bad, actually. Dude, that was funny. What is the dot plot? Okay, so the Federal Reserve started doing this, and the ECB does this now too, where basically once a quarter they ask all of the members of the Federal Reserve what they think interest rates will be in the future at all of these different points. And then you get this chart that shows you kind of a plot of where everybody is at. Okay, most of the members think that there will be 3 cuts next year. And where do they think it will be 2 years from now and you get this kind of plot. And then, of course, as things go along, their projections change and everything. And I would say, I'm not going to say it's controversial because I don't necessarily see people being like, we should just get rid of this. This is stupid. But the projections that they make tend not to be what actually happens. So there's kind of this whole thing where it's like, that is just their current projection, but the market treats it as like a prediction and then starts to follow that prediction. And so that's why it's a interesting concept. Is a great way of putting it. Oh man. Well, I wouldn't use it as a control. I think that it is an extremely effective indication of like what current expectations are, because they do tend to follow, you know, what the market and the current data in general believes. It's just that they change, right? When we were a year ago, they were predicting, I think that the FOMC members were predicting 2 or 3 rate cuts. And now it's looking like maybe 1. And you know, like they expected that they were going to be cutting a lot earlier too. It's kind of funny though. It seems to me like all of their projections originally were correct, and the most recent data has kind of thrown them off, is what I think has happened. I think if you haven't read these stories over on Zero Hedge about the jobs data, I think that's worth reading. Basically, they're saying that a lot of our economic data relating to jobs has been a mirage. That they've said that we've created 1 million more jobs than we actually have, and that furthermore, the jobs that are being created are almost all from illegal immigrants. And so this would explain why the average person still feels squeezed and feels like the economy's not doing very well and so forth. It's because they're not really creating new jobs for regular Americans. It's all immigrant labor. And so this means that the underlying economy is not actually as strong as a lot of these non-farms jobs and so forth suggest. That the real economy is actually much more in line with what all of the projections were last August, which would mean that we should have cut rates in May and all of these sorts of things. So that's what makes it kind of funny, is that like they thought that they were going to do cuts, and then when the time came, the data didn't support it. But then actually it looks like that if they really had the full picture, that it would have supported their original. It's just so weird. But then there's this other thing. If you go before the pandemic, so TLA Trader says if you know their history, but it's really the history of the dot plot is not that long. Okay, it hasn't been around for that long. Before that, it was, we're going to raise interest rates next year, and then they wouldn't, right? They keep anticipating that in the next in the mid future that they'll raise interest rates, and then it doesn't happen. They keep them low. So. But I think you got to be careful with that, because there are a lot of people that just despise the Federal Reserve no matter what they do. And they're going to try and use that to criticize the Federal Reserve. And that's why, again, it's an interesting concept, because it kind of gives people ammunition to say, oh, see, like their projections are always wrong. They don't know what they're doing, yada, yada, yada. But then the whole thing is, the whole time that they're saying is that like this is not a projection or this is not like a prediction or anything like that. It's extremely likely to change. I wouldn't base all of your expectations off of that. That's just what we know currently. But everybody ignores that. Okay, so easy inflation is 2.6% last print, and now they are cutting rates. Make it make sense. Okay, sure, I can make it make sense. So the thing that you kind of have to keep in mind is that there are different measures of the economy, and some of them are more forward looking than other ones are. For instance, employment is very backward looking. So what will happen is, if I were to draw, like, this is what would normally happen. Okay. Okay, here's the economy, and it's going up and up. Oh, we need like a yellow there. Okay. So here's the economy, and it's going up and up and up and up and up. And so what do? They say, we need to raise interest rates, right? Okay. So now we've raised interest rates. What's going to happen is the economy is going to start going down, and then you'll get a recession. Okay. But if you're raising interest rates here, until it's very clear that a recession is happening, right? Then the raising rates kind of makes the recession happen, right? So that's why what you want to do is you want to cut rates here, and bring them to a more reasonable level so that the economy doesn't go into recession. It just kind of goes sideways and then up, right? And ergo, so again, with inflation, you would be seeing it like inflation is high, but because we're raising rates, it goes down, right? And it's coming towards the target, but it's not quite there yet, right? But then when you get through this point, then it's going to get to target and it's going to go sideways. So you have to start cutting interest rates before you get to the target. You do. If you start cutting interest rates after you get to the target, then you probably had the rates high for too long, and the economy there's danger of the economy going into recession. This is why they talk about it as like a soft landing, right? Is we're coming down. Okay, so coming down is like we're raising interest rates and slowing the economy down, right? But then we need to nose up a little bit before, otherwise you're just going to slam right into the pavement and crash the plane, right? So you need to bring things up a little bit so that you get a smooth landing, right? So you're going to want to, and all of the economic data that we get right now does kind of suggest that if they don't, soften the interest rates a little bit, that the euro economy would go into a recession. So based on that data, they are doing the correct thing. And presumably, because those, like those inflation measures and so forth are kind of a little bit lagged and everything, you will continue to see those go down to their targets. Now, the problem is what if you're wrong? What if inflation is not consistently moving down and it will continue moving down to the target, and you soften things too quickly? Well, then you risk the inflation taking off again. You don't get anyone talking about it. Well, that's not true. Every recession that I've ever seen in my life, there was plenty of people talking about it long before it happened. Like, bottoms are an event, but tops are a process, and the market actually has a pretty good idea that it's starting to happen. There's a lot of things that you can kind of see ahead of time. It's just like the yield curve inverts and then starts steepening before the recession really truly happens. Before, like, it's panic in the streets and it's on the news and everybody knows. Well, I wouldn't say that you're already in a recession, but there are some things that don't look good over there for sure. I don't think that I would say it's gambling, DC Verax, because that's the thing, is that economic data is much more predictable than a stock chart is. So I'm not exactly sure what exactly she had said, but that was just kind of like the last question. Maybe it was just them buying as they anticipated her speech ending, but we bought up a little bit. I don't see a super what would I say? I don't see a super strong flow bringing us up, but we did see some movement in the Japanese yen. And the dollar came down with it too. Maybe that was intervention in the yen. I don't know. Germany is cooked. 200-day moving average on ZN is 130, really? Oh, wait. What are we talking? We're at 110. Oh, you're talking about 13. 110, 13. Was it the second to last question where they kind of took off? But I, you know, obviously I don't pay attention super close, but I didn't see something that like really, let's see here. $110.13. Okay. Well, I'm being silly. I should just pull the chart up and be like, oh, okay. Daily ZN. Oh, you're right. This 200-day moving average might provide some resistance. I don't know though. When I see those kinds of numbers, I think that you could see some long flows come in after that, but it also like kind of those spots tend to get messy, right? Well, 08 is buyer cost basis. Yep. Helps to at least be aware that people are going to try against you. Yeah. Well, the thing, yeah, that's where it's like, I think at 130, I would be keeping an eye on if new flows come into the market to continue to push it up, right? So there's a possibility of a strong trend developing off of that. But even if there is a strong trend developing off of that, there will be counterflow to it. I'm going to try turning this lumbar has like you can adjust the depth of it. Maybe I just need the lowest lumbar support because I do kind of feel like it poking me in my lumbar. Gotta get it in just the right spot. I'd say so far my back is my mid back is feeling pretty good though. I like the way that it kind of cradles me. Makes me feel safe. Okay, but anyways, I got distracted. The point is that if you wait to cut interest rates until inflation is consistently at 2%, then you will probably leave interest rates too high for too long and will probably go into a recession. So you need to be sure that inflation is heading to the target, but you don't want to wait until it is at target. Does that make sense? Right? I want to see if this is 2% inflation and, you know, we've had, we're doing this and then, oh, inflation, Joe Biden's president. Okay. We're coming down. I want to see it consistently coming back down this direction, right? I want to see that before I say I'm going to start cutting interest rates, right? And the problem is that we were kind of like right here. We were kind of like right here where it was like, well, inflation is coming back down. So it seems like but you know, it's not quite, we're not quite confident that it's heading in that direction. That's where we were at. Now we're kind of like more like right here, where we've gotten like 2 or 3 months now of, it does seem like it is continuing back down to the target. So now they are getting to the point where they want to raise interest rates so that, cut interest rates so that when you get back to the target, it just, you know, it stays at the target. Instead of, you have a recession and that would be super bad. Right? This is recession. There you go. You can't control the world economy by moving interest rates up or down a few points. And Uzi says, actually, yeah, dude, here's the thing. So let's go back to our basic framework, okay? Understanding how a market works from its most basic, most fundamental level, and some of the interesting empirical properties that come from the system that we use. You scale them up to the large scale and you can learn some very, very interesting things. So what do we know? Okay, the way that the market works is it's a two-way limit order book. So there are offers and there are bids, and most of that is market makers, and some of that are people that want to be executed, but most of it is market makers. And then if somebody comes in and they want to buy something, like a lot of something, then they're going to have to trade against those liquidity providers and move the stock up or down. And that's why things move. But there are kind of problems, like because the liquidity provider, you know, he doesn't want to be trading against you if you really know what's going on and which way it's going to go. And so they can kind of pull their offers, and then people don't want, you know, if they want to get filled on a limit order, they often don't put their limit order out there where you can see it until it, like, just as it's going to happen. And so you kind of get these weird holes that will form. We'll call them liquidity holes. And the result of the liquidity holes is that you can only push something so far. There's kind of like an upper limit. And so you'd think if I traded 1,000 contracts and I moved the market yay much, that if I traded 2,000 contracts, that it would move the market too yay much, right? But that's not what happens. It's actually, it moves the market 1.14138 something, right? The square root of 2, okay? So it's a graph like this. There's kind of an upper limit on how far it can go until you get to like something super crazy is happening and then it just like spikes, and that's an unhinged market, okay? So there's an upper limit to how far you can move something, right? But that's the thing, is that the money coming into a market, somebody buying or selling something, is what causes that market to move. So what do we want to know? We want to know, are there new orders coming into that market or coming out of that market? Okay. Well, so if somebody is going to buy a ton of treasuries, where are they going to get it from? Where does it come from? Well, almost all money is created by banks. It's created by as banks give loans to people. And the higher or lower that interest rate is, the more people can borrow money to go out and buy things. Okay. So when people buy things, when people take loans out, that objectively makes the market move up. Like straight up. This is the mistake that everybody made when they did quantitative easing. There's all these people that are like, well, the economy must not be very good if they want to do that, so I'm going to sell it, thinking, well, this is a reflection of the fundamentals. That means that the market shouldn't be valued as high as it should be. But no, That's not the way that it works, because the market is not efficient. The market moves based off of the orders placed into it, as we had just described. So they print more money, it moves the market up. It just straight up it does. And if you take money out of the market, if you tighten the money supply, the market goes down. If you're looking for leading indicators, okay, like which direction is the economy going? The two most forward-looking indications that we have are new orders, which is what we got yesterday with the ISM PMI numbers, okay, Purchasing Managers Index. That's like with the people that buy the things, what kind of orders are they submitting? Okay, so new orders and money supply. Money supply is huge. So yes, it is absolutely, it can be almost reflexive. If the Federal Reserve came out and like reduced interest rates by like they did a double rate cut or something like that, I would just buy. I like, don't even think about it, just buy. Like in COVID. COVID was a great example. It's like, oh, the Federal Reserve's printing all of this money, all of these things. Oh, but is the economy really bad? Like COVID must be really bad. This is super crazy. You can also don't just buy it. Just buy it. More money supply, it's a buy. Yeah. So can you control the world economy by moving interest rates up or down a few points? Yes. It has an extremely powerful effect on the world economy. An extremely powerful effect on the world economy. Market makers, they always play my mind. They show weak and then they trigger orders. Holy crap. Well, so here's here's how you deal with that, right? Is the market maker doesn't want to trade against somebody that is informed, right? The market maker wants you to think that you are informed so that you'll buy into them when there's nothing going on, right? So the market maker is going to do all of these things. They're going to add a certain amount of randomness into the market to make you think that it's going this way or that way, so that you're convinced that you're informed and that you know that it's going to go up because of technical pattern A or whatever it is, right? And so the trick is to actually be informed. If you're actually informed, then when you see that move happen, the market makers kind of adjust themselves a little bit and do something that makes the market move in a way that catches your eye and everything. But then you're going to go and say, but wait, there's nothing going on. There's no reason that anybody should be buying right now. And you can know, oh, yeah, the order's just pulled. It's just the market makers, injecting a little bit of randomness into the market, and you just ignore it. Are things not different now than they were in 2007? Whole new world, previous information still being pertinent, but new realizations possibly necessary? Well, I think that the important thing to understand here is that orders move markets because of the way that the market is structured, kind of affects how it can move and how far it can move at a time. So the market is not informationally efficient, right? So we all thought, oh, valuations matter, all of these things. Like, yes, there's like small aberrations and like new news that needs to be factored in and everything, but like overall the market is very good at knowing what the true value of something is and going to that, right? Well, that was just a theory. That was just the theory that they sold us in the 80s. That like, it's funny that when the politicians fully embraced that informationally efficient view of markets, we're just going to rely on the market to tell us everything because the market knows all and we're just going to trust the market. At the same time that the politicians were figuring that out, the quants were over here in the actual market discovering the true nature of the market and figuring out that, oh, actually it's not efficient at all and we can take advantage of it. Isn't that funny? Because look, you need, markets are an important feature. Okay, there's just no way to share the information. We all have different information. There's no way for us to get it all into one spot so that the supply can come to meet the demand. Right? So you need markets. Okay? You just got to realize that the market can be completely full of crap. So the existence of a market does not mean that you don't need to know what's going on. That's the mistake that the politicians made, right? The politicians said, oh, well, we can, and CEOs too, quite frankly. They said, oh, well, we can just rely on signals from the market to tell us what to do. And no, it's not true, because the market is wrong all the time. So the market is useful, but you still need to know what's going on. That's why we follow the economic data. We try to understand the economics and the macroeconomic picture of it, right? And then we also have to understand the kind of technical, empirical properties of order flow. And we have to know, like, what people are doing in the market, people that might need to buy or sell, like what their strategies are. And we need to know the sentiment, how people feel about things overall. And those are all things that we can factor in to determine what the flows for that day are going to be, and then determine if there's a strong enough of a flow for us to try and get in front of it. Right? So that's how these little things that we understand at this level, you kind of go bigger picture and you start to understand, because of the because of the way that a limit order book works, the market as a whole cannot be informationally efficient. What matters? New orders. Money supply strongly predicts new orders. Money supply strongly predicts new orders in the markets as a whole. Now, here's another thing, because you were asking, are things not different now than they were in 2007? If there's been any change in the markets since 2007, I would say twofold. Number one is that after 2008, the robots really took over as market makers. I mean, it was happening before that, but during that period, it really cemented things. Like the remaining market makers that were like executing manually, humans kind of disappeared after that. Okay. By 2010, those guys were chased out of the market. That's where the whole Navinder Singh's flash crash came from. Was like he was one of those market makers, and the robots were killing him, so he took his revenge. Right. That's change number one. Change number two is that the public figured out that index funds are a really great way to invest, and so more and more and more money started to get allocated to index funds, which actually makes the market even less informationally efficient. I wonder if a day comes where we get good enough at predicting what the index funds are going to have to do that we can front run it, and it increases the costs of execution for index funds so much that investing in individual stocks and mutual funds becomes a better deal, let's say, becomes a better deal relative to index funds. I think that would be a good thing for society, because we need people to own individual stocks and then, vote at shareholder meetings and help guide corporate governance policy in a direction that is good for the public, right? Yeah, just because it's been good to invest in index funds does not mean that it will be so in the future. Well, there are some fundamental things about investing in an index fund that works, that will never go away. The problem will be the costs, right? there will come a point where your performance on the index fund, if your performance on the index fund ends up being like 2 or 3% less than the actual index, so that would be the measure that I would look at to see if this is happening, is the average performance of an index fund relative to their benchmarks. And if they start underperforming, systematically underperforming their benchmarks, then you know that the market as a whole has figured it out and has increased their costs enough that it doesn't make as much sense to just be in index funds. Because once you're down like 2 or 3 points on the index fund, then you might as well just pick your own stocks. Just pick 5 stocks that you like and buy and hold them. And like, average person will perform the same as the index. And if they underperform, then they would be, 2 or 3 points underperform, which would be about the same as what the index fund is doing. So you're not missing on anything by doing it yourself at that point, right? So that's why I say it would only take a few points to kind of upend the index funds and make them not as worthwhile. And then maybe the index funds would get a little bit smaller, and that would, it would stabilize to a point where pick and choose. You don't want to do all of the work, put it in an index fund. You want to do all of the work, buy and hold stocks. And it will be about the same. Whereas right now, it's like your average propensity as a retail trader is to underperform enough that the index fund is a better buy. Unless you really know what you're doing and you really put in the work. Leon says, I'm happy because I predicted news right. Oh, well, there you go. Okay. I do find it curious. I kind of wonder if the rally that we saw here at the end really was just, oh, the ECB conference is done. Now we can buy it. I don't know. Yeah, I can feel like my back, some of those muscles, like relaxing and healing. So then when I come in, I stretch it by like crossing my arms like this, because they were all going like this. Now they're like, oh, this is helping. I think I sit in this seat a little harder than the other one, but that's not. I also, still I have a tendency to slouch. So, you kind of have to think about sitting up straight anyways. I maybe might move my arm a little bit so that I can pull it back further here. And maybe I'll also put it completely vertical sometimes. Talking about my chair. Now, this has been a little while. Let's test myself on the typing here again. I started out really strong there, didn't I? 112. But fatigue started to set in. Fatigue started to set in. So I've got 45 minutes left. I'm curious to see what it does here. I find this movement overall for the session, all of it to be a little bit like, okay, I'm sure I understand that one, but okay. On the same hand, I'm kind of not expecting too much just because it is non-farms tomorrow, right? So, oh, while I'm thinking about it, we should come in and check to see that it is properly exporting some data over here. Oh, it looks like it is. But it also looks like it's exporting every bar that I've got for this session. Oh, no. It's just from when we started it, because we started it at 7:39. Yes, okay, cool. I guess I should add a feature in here that will tell you when the value was live versus tick replay. Make them grayed out so that I can kind of tell that too. Elon Musk Starship successfully completes 4th test. China property stocks tumble into bear market as Beijing's bailout fades. ACLU to sue Biden administration over new border rules. We intend to sue. A ban on asylum is illegal, just as it was when Trump unsuccessfully tried. You know what? He just needs to go back to that you stay in Mexico while your asylum claim is being processed. That solved the problem, man. It really did. It's going to be really interesting to me to see the way that the public reacts to the changes that Biden is making on border policy. Like, will he actually fool people and have people be like, oh, okay, he's going to get the border in control and yada yada? Or will they correctly see it as, just a cynical ploy for the election? How many people will get fooled by it? I'm curious to know. The U.S. economy has seen an unemployment rate below 4% for 27 straight months, the longest streak since the 1967. MSNBC. Okay. USAA members share bank fraud experiences. USAA having problems? That's concerning. Well, looks like Keith Gill may have uploaded a new unlisted video on YouTube. Oh, no, video unavailable. It is private. I missed it. What was in it? Unlisted doesn't mean people can't find it. Well, we might as well, while we're thinking about it, come over here and see what they're doing this morning. Yesterday they had a good pump during the regular session. Oh, it looks like it's still pumping, man. I don't know what to think about that. I don't think that it's doing it for any reason. I think that it's just crazy people buying it. It's kind of funny, like his initial thing. Yeah. Okay, it moved it, but not that much. And come back down here, and now it's going up again. But is that... let's take it to like 30-minute bars. Okay. Okay. Now let's see how far they get. Let's see how far they get. Thing is that I think that this goes until like the options expiration. So probably be worth checking in every day. Till then. Looks like here that they don't know what was in the video, only that he was putting them together. That's the other thing, is if I sit up straight and I go like this, I should be able to, you know, if something's out a little bit, I should be able to get it to go right. To what YouTuber? We were talking about Roaring Kitty / Deep Effing Value, the GameStop guy. Apparently he uploaded a video, but it is a private video, so you can't see what's in it. An unlisted private video, which means that people can see that it got added to like a playlist, but we can't see what's in the video yet. So now these guys are speculating that he's ready to put a video out to pump GameStop further. Wait, you guys actually pay YouTube Premium? I thought it was a joke. Me too. But there are some of my viewers. You guys do that. You know, if you didn't have all of those other streaming services, it would totally make sense to have YouTube Premium, in my opinion. Wonder if they're going to end up as Lost Born. Time for me to stand up, stretch a little bit. Do feel a little bit of tension from this chair in my lower back, but I think that is from, you know, squatting really heavy yesterday, and some of my hip flexors and things like that aren't completely there yet, so Have you ever used Book? I actually, not seriously. I've like installed it, like checked that it works, gotten a decent overview of the features, but I've never like actively used it to trade. The whole thing is that I'm really not a fan of the Vista charts, book like market depth charts sort of a thing. I think that it's a gimmick for the most part. It's cool. There is useful information on it, so it's better than nothing, but it just doesn't hold a candle to what you can see with the DOM. So I made a post about this on Reddit the other day that was pretty popular. So I'll just kind of give you that same spiel. So the thing that you want to see here in the market is that people don't want others to see what their intentions are. So they don't always put their liquidity out. So we see that there's 5,000 contracts at 06.5. There's a good chance that once they start executing there, that a lot of those cancel. So you can see as we move down, at least 1,000 of those canceled. You might see them able to tick through that on 3,000 contracts. Okay. But so it's almost always the case that when you tick up or down that you see a lot of orders cancel. But it's also almost always the case that it takes more orders than you can see there to be able to make price tick. And that's because these guys, they don't want people to see their intentions. And so they don't put their limit orders out until like right as they're about to execute. Okay. So we call that kind of available liquidity that you can't actually see the latent liquidity. So when I'm watching the DOM here, I want to see what that latent liquidity is. That's why I'm watching every time that it ticks. Okay. So now it's pulled to 1,800, but it might take more than 1,800 contracts to trade through it because of the latent liquidity. Right? And if it doesn't, if it only takes 1,000 contracts to tick through it, that's something that really sticks out to me too. Market makers are getting out of the way. Why are they getting out of the way? Okay, so it only took 14, 18 contracts to tick down. That really stands out to me, right? That's kind of a little bit of a warning to me that we're kind of on the end, and we've kind of been on the downtrend anyways, and the cumulative delta has been going down, right? That could continue. I don't think that I would want to be sitting there with my buy order at 06, for instance, right? You can't see that on Bookmap. Bookmap will just show you, oh, there was a big order here and there was a big order here, and it focuses all of your attention on those big orders, which I honestly don't think help you that much, right? So that's why I say that those charts just are not nearly as effective as what you can see on the DOM, because the things that I think are important are very, very difficult to see on those charts. You say useless. I'm not going to say that they're useless. Like, I mean, it's better than not having any idea of what the liquidity is. It's just not half as effective as a DOM is. Now, the caveat to that with Bookmap is that Bookmap does have a DOM as well, and it's a decent DOM. Okay. I don't think it's as good as the Jigsaw DOM, but it is a decent DOM. So I think that Bookmap is a good platform. It's just not my preferred platform. Yeah. Just know that the DOM has more information, that you really want to have a DOM up on your primary market at the very least. You also want to execute on a DOM. There's no better way to execute than on the DOM. Okay, Sierra Charts. Why are we asking about all the different platforms now? Okay, so Sierra Charts is a good platform too. The good thing about Sierra Charts is that it's written in C++. It's extremely optimized and stable. Okay. The big downside of Sierra Charts is that it's not organized very well. It's just kind of like a smorgasbord of features that people requested that, you know, aren't organized at all in any kind of reasonable way. So like learning all of the different features and ways that you can use Sierra Charts is really hard. And they don't innovate. they are basically taking ideas from other people and adding them into their platform. So Sierra Charts is a good platform. It's a little bit cheaper than Jigsaw, but not by much. It's like I feel like if your choice is between Jigsaw and Sierra Charts, it's like, is $10 a month really a big deal to you? Because that's like the difference between the two of them, right? But a lot of you guys really like Sierra Charts, so you know it's good. I think that my audience is like split 3 ways between Jigsaw, NinjaTrader, and Sierra Charts. But Jigsaw's DOM, or sorry, NinjaTrader's DOM is useless. That's why you use Jigsaw and NinjaTrader together. But I also have a lot of people that just use NinjaTrader because I have a lot of NinjaTrader videos. Are you asking me a question there? You have a good background IT or in IT? I am a site reliability engineer. I never thought that I was like, you know, okay, so I'm a coder. Am I like a super amazing coder? Am I super amazing and knowledgeable about software things? And I always thought, well, not really. Maybe I'm just average. I'm pretty good at solving problems, but this is just because I enjoy difficult problems, and that's like one of the few things I can focus on, you know? But as time has gone on, what I've learned is that like the older you get, the smaller of a percentage you are. Like I thought, oh, we're millennials and all of these things, so we'll be a big percentage of the industry for a long, long time, right? That will be like half of the industry or something like that. But apparently that's not the case. Apparently now I am like more experienced than like 80 or 90% of developers. And I'm doing site reliability engineering, which is pretty demanding. And I'm fixing performance issues that really require like a deep understanding of the frameworks and the code that you're using. So it turns out actually I'm a pretty good. I think about that sometimes because I'm like, you know, if I was really going to make a YouTube channel about what I was the most expert in, I should be making more stuff about programming. God, I love trading so much. I'm new to your channel, so can you explain how to use the DOM? Did you miss that whole spill that I just gave about the latent liquidity? So, that's not everything, but that's a critical point about how we use the DOM. I don't know. I'll wait for your response to that, and I'll start from a different spot. When it comes to my trading, the biggest thing that I'm trying to do is I am trying to predict future orders. Basically, I have an idea. There is something going on in the market. This player is going to have to buy, or this group of people is going to want to buy because of this thing or whatever. And the balance of all of the flows that I know about says that there's going to be an imbalance in buying. So once I know that, then I'm going to go out and I'm going to look for opportunities to get ahead of that flow. Didn't understand. Okay. So then I'm going to come over here into the DOM and I'm going to say, okay, am I seeing signs of that imbalance? Okay. So the highest level thing that you can look at is cumulative delta, which is not the DOM. But I recommend having a cumulative delta on there because this is something that you could see on the DOM, but like, you know, you're really going to have a really good idea just from watching it, whether there was more, how much more buying than selling there was market orders over the last 30 minutes. Yeah, not really. So what you want to see in cumulative delta, and you got a pretty good example here in the 5-year, is we want to see like what appears to be a trend in the cumulative delta, which means that there is a long-term imbalance between market buys and market sells. There are more market sells than there are market buys. And the cleaner that that line is, the more of a straight line in one direction it is, the better. Okay? That's that persistent imbalance that we want to see. Okay? Now, the problem with that is that by the time you see it, it might be too late. Okay? So then we got to come over here to the DOM. And what are some signs that we can see in the DOM? Well, one of the things that you're going to see, first of all, is that there's almost always going to be one or two prices that have less liquidity than the others right at the, best bid, best offer. So you can see right here, I'm looking right here in ZN. Okay. Maybe make that a little bigger. We're like right here, okay. This price right here, this 10.07 half right there, that only has 1,400 contracts, whereas everything else has 3,000, 5,000 contracts. Okay, so that's typically what you're going to see is like one of the inside bid or inside offer will be really low. The other one will be somewhat low. This is 3,000. And then after that, the liquidity outside of that will be higher, right? Then you get to the 5,000s, right? Okay. So if I were to draw a graph of it, like what is the liquidity overall? It's kind of like this. Kind of like this, right? Closer we are to the current price. Okay. So what happens is the less contracts there are, they're at that price, right? Like right now, 550. So that means if I market bought 500 contracts, it's likely to tick up like it just did there. That's called catching the edge. If you can buy it as it's ticking up, and now you could, if all of a sudden you changed your mind and you decided you wanted out, you could just, sell at the exact price that you bought in. You could scratch it for break even, right? So if I'm going to get in, I would prefer to catch the edge. And you do that by kind of watching when that inside price that is lower is really low, okay? The other thing that you can do is sometimes you will see an iceberg. Like maybe they sell into 07 half to try and push it back down after it just upticked there, but then there's an iceberg. So if I want to buy, I could also buy at that location, and I'm fairly likely to get a fill. And I've got this iceberg, so it's harder for them to go through me. Okay. So that's called icebergs. Okay. So those are two things that I can kind of do tactically to get a better position. And then overall, I'm just watching these inside levels. How much does it take for me to tick up or down? Has that changed? Does all of a sudden it's taking more orders for me to clear through or less orders for me to clear through? If it ticks up and then it ticks back down, first time it ticks up, it takes 1,000, and then it does it again, it does 1,000, and then all of a sudden, this next time when it ticks up, it takes 5,000. Those are the sorts of things that I'm watching. And those are all kind of like tea leaves to give me an idea of, is there an imbalance between market buys and market sells? And buyers and sellers in the market overall? Because what we want to see is there's going to be an equal number of buys and sells, right? But one side is going to be more aggressive, right? So all of those little things that I see on the DOM are all kind of little hints. And if I get enough of a hint that is in line with my larger expectation of the flows, that's when I take a trade. Does Ninja? It does. It's just not very good. So most people that use Ninja Trader, you can use Ninja Trader and Jigsaw together. And that's what a lot of people do. There are also add-ons and stuff you can buy for Ninja Trader that improve the DOM. That's basically what we do. So, I have a video series on my channel page. It's like the order flow video series. It's about 5 or 6 videos. And if you're new, I would recommend going and watching all of those videos because I go into all of the empirically proven behavior. Well, first I go and I explain to you what the DOM is and what you're looking at. And then I explain to you empirical properties of markets. And then I explain how that results in kind of the higher level behaviors that we see in the markets that make trading so hard. So you go through that video series, you have a really good idea of what's going on, and you'll have a good framework to work from there to build your own strategy with. Your own strategy that is informed by the reality of markets so that you actually stand a chance. And that video series in particular, I really think is what makes us different in this channel, different from other places out there. Because I didn't come up with this stuff, right? Most channels, you know, like the ICT guy, he's like, I created this trading strategy because I wrote the algorithm or something like that. No, you didn't. What you did was you took concepts that other people had taught and renamed them and or just repackaged it, right? Well, what I did was I went and I had found empirical information, things that like people in the industry are using, but retail traders don't for some reason. And all I did was I just took that information and helped you apply it to retail trading. Because what happened was, you know, this research has been out since the 80s, but people said, yeah, but it doesn't apply to retail trading. They didn't understand. They thought, well, this is really only useful to you if you're going to execute a really large amount of something and you want to reduce your impact. And so they ignored it. And so that's all. I didn't come up with this stuff, right? I just applied it to you. Oh yeah, can you bring up the cost basis chart? Sure. But I don't think you're gonna like what it says because it says that we're just stuck between the buyer and seller's cost basis right now. Interesting. Like, once again, has there been a day? I feel like we look at this every day. And every day that we look at it, I'm seeing things like this. Where it goes right to those lines and almost immediately turns around. Or there's like a big sweep and it goes right to the cost basis. It's just like... I don't understand how I can have a line that's that effective and yet not completely be able to backtest something that really shows a really effective strategy using it. But apparently a line is, you need more than a line. You need to know what the future orders are going to be. You know what the future orders are going to be, and then those lines become a lot more useful. But when we're stuck between the buyer and seller's cost basis, that to me is like, there's not actually any super major flows going on, and it's just the market maker bouncing it between themselves. Is what I see in the market right now. So, obviously no trades for me. I don't anticipate taking any trades this week. Maybe tomorrow non-farm something crazy could happen. It's interesting. I still have to think about sitting up straight. Because I want, especially with the microphone here, I want to lean into the microphone. But I need to sit up straight. Now, with the other chair, it was like I didn't really have anything to push against, to rest my back up against. And so I think that was making the back tired. And that was super comfortable chair. Wonder what I should do with it. So if I decide I like this better, I bought this one. This is like, I cleaned it. I already told you. You know, you can tell I'm obsessed with the chair today, right? Sorry. I bought this chair for $125. It's a used steel case Leap. Steel case Leap is like the best chair you can get. One of the best chairs that you can get. This one is super worn though. So I'm kind of sitting here like, if I like this better, should I sell my old chair and buy a brand new one of these that looks a little nicer? Doesn't have the armrest all scratched up. Well, I could just buy new armrests. But this is also, I think, the old version of the Leap. So a newer one would be better. And I could get a better material, and it could be not red. But I think that if I was to do that and buy a new one, I think that I would want to sell my old chair and try and make some of my money back on my old chair. But I don't know if I would actually be able to sell the chair. I think it would be hard to get my money out of it, at least from a local buyer. I could put it up, but I don't know if there's going to be people that want to buy it for $800 or whatever. I mean, I guess you're saving $500, so you're saving by buying it used. But... oh, I don't know. But it's such a good chair, though. It's so comfortable. You know what? I don't have the lumbar support in that chair. I think I'm going to buy the lumbar support and put that in there. And then reassess. Okay, so we got a few minutes left. Let's come into Zero Hedge here and just see if there is any economic analysis worth taking a look at. Russian war strips steam for Caribbean as Ukraine tensions go global. Oh my. OPEC Plus ministers dismiss bearish market reaction to output plans. That's it. There's not really a whole lot this morning. The Starship launch is the top story. I think also one disadvantage of this chair is it's not as good for like leaning around and sitting in different positions and stuff. So how about a trading plan for tomorrow's non-farms? All right. I don't really like trading non-farms because I usually lose money from it. But tomorrow... so we are expecting average hourly earnings to be to spot 3 versus a previous of spot 2. Non-farm employment change to be 186,000 versus a previous reading of 175. And just note, if we come in here and look at the data series, they like continue to beat the consensus expectation by quite a bit, except for May's. Okay, so my expectation would be that while I actually 186 is actually probably pretty close. So I think that they are probably going to be closer to the consensus expectation than usual. Okay, so that would be my expectation. A couple of scenarios. If it comes out and it's another 250 to 300,000, you know, total jobs, and they just absolutely smash the expectation again, then this market is probably going to sell super, super hard. Because what we're seeing right now is there are some concerns about growth, but if we continue to see the employment numbers super hot and hotter than anticipated, that makes it really hard to cut interest rates. And so the market will be very unhappy about that. That would be like you know, that could lead to more of a stagflationary environment. And, you know, equities will be unhappy both because growth is low and because interest rates are expected to remain high. Okay, so, and then of course treasuries would sell as well. So that would be sell all the things. Whereas if the number is very, very weak, like 186. So if it was like last month's at 175 or so, I don't think that would be enough. But at like 150 and below, that would probably result in another bull run push to the highs. So those are kind of the scenarios. I think that your chances of getting like a good trend that you could jump on are probably better if there was a big miss. Okay. But I would also keep an eye out for some of the nuance in here. The average hourly earnings is going to be important. Like if average hourly earnings came out at spot 4, that would be really bad. Spot 3, spot 2 is okay. Spot 2 would probably be somewhat positive, but not like a huge deal. Spot 1 probably unlikely. Unemployment rate changing will also matter because there are two parts to the non-farms. There's the establishment survey and the household survey. So the establishment survey is they go out to payroll companies and they say how many new employees are there this month, right? A household survey is they go and they call people. They call landlines, okay? And these two reports have kind of been diverging as of late. So if there was another large divergence between the unemployment rate and the average hourly earnings, that could provide some complexity that might allow you to take a trade, okay? But yeah, I don't expect, so I'm probably going to be super trigger happy tomorrow. So we could take some sim trades, but probably not any live trades tomorrow. Because I'm likely to just do something, take a really stupid trade and lose money. Plus, non-farms are awfully fast and volatile, so you can lose money on them really quickly. So really got to be really confident about like which way the flow is going to be, which with non-farms lately doesn't happen very often. And yeah, I would say that's about where I'm at. Or what I think about it. And that puts us, so we've still got a minute or two left, but interesting session today. Lots of questions, and we stayed conversing pretty much. I don't think we had like a super big break in the chat today. Pretty much all day, but maybe that's because, it was ECB and you guys are probably doing less trading today. Kind of risky to trade during ECB press conference. Checking around and see if there's any other good stories, but not really seeing them. So I think it is time for us to close up for the day. So tomorrow, non-farms. Even though I might not take a trade tomorrow, I wouldn't miss it. This is very important data to look at and analyze and market action to watch or even if we don't trade it, we learn a lot from it. So I will see you guys tomorrow. In the meantime, stay excellent.